Hello, welcome to YOLO Crypto. Today is Friday, February 21st. I'm Daniel Scott Jacobs. Today we're going to talk about how does the bond market work and how does it relate to cryptocurrency, because you can essentially front run or get a better estimate about where cryptocurrency prices will be going based on bond prices. And bond prices have to do with inflation, um, quantitative easing from the Fed, um, the bond yields relate to bond prices. They have an inverse relationship. So we're going to explain all this. Let's get started. So, bond market, right? So this is from Investopedia. This is where investors go to trade debt securities. Okay, doesn't tell us much. Let's move on to bond yield. So the annual rate of return on a bond expressed as a percentage of the bondholder's invested capital. Okay, so right now the bond yield is around, I think it's like 4 point something percent. We're going to get into all that, but I just want to give you a couple basic facts. This is from Investopedia, so you know it's right. Uh, um, let's look at the yield. So this is the bond yield, right? And you for I think a 10-year Treasury, right, which is a government bond. That's what they when they say Treasuries, they mean the government. You can see it was very high in the early 1980s, and it's continued to kind of decline, and just recently come back up. So the main reason for this decline is because of inflation and also quantitative easing. So when they started lowering interest rates, right, makes bond yields go down. Okay, because essentially there's cheaper capital out there. So when you see interest rates go down, that's when short-term bonds, the yields on short-term bonds, which could be as low as a month, 12 months, a couple of years, and they go all the way up to 30 years, you'll see short-term bond yields be higher. And then when there's long-term bonds that cost more, when the yield is higher, you're generally looking at higher interest rates, okay, or a projected higher interest rate. And there's many other things to tell based on where bond yields are at, like if there's generally no difference between short-term bond yields and long-term bond yields, that can kind of signify economic uncertainty. And there's a whole list of them. I'm not a bond yield return analytic expert. I'm just giving you the basic facts that you want to know in order to help your cryptocurrency trading and try to estimate where the economy and where crypto prices are going to go. Okay, so let's see. I have a better definition here, okay? What is the bond market? So the bond market is where governments, corporations, other entities, municipalities, issue and trade debt securities, which is bonds. Okay, investors buy these bonds in exchange for periodic interest payments in the return of their principal at maturity. So you buy a bond, and you're going to get paid the interest, the yield, right, periodically, and then you'll get your lump sum. So let's say you buy a bond for $1,000. Okay, you're going to get paid interest on that $1,000 up until the maturity date. And at the maturity date, you're going to get your $1,000 back. Okay, that's how it works. So how does it all work? I just told you. But let's take a deeper look into this. So what is a bond? A bond is essentially a loan from an investor to a borrower, a government, company, or municipality. Municipality would be like a town or state. Okay. In return, the borrower agrees to pay principal interest, called the coupon. You hear all this talk about coupons. It's a periodic interest. Okay. And repay the principal amount at maturity. Okay, and then like you'll hear terms like junk bonds, right? Those are essentially bonds from less trusted entities. Okay, essentially making them junk, right? So primary versus secondary bond market. So the primary market, this is where new bonds are issued and sold directly to investors. Governments and corporations issue bonds to raise money for corporations, infrastructure, or debt refinancing. Secondary market. After issuance, bonds trade among investors in the secondary market. Much like stocks, prices fluctuate based on supply and demand. Bond pricing and interest rates. Okay, so bond pricing and interest rates have an inverse relationship. Excuse me, Jesus. Take a little sip of my toilet water here. Almost like house prices, right? When you see like to take during the pandemic, for example, like interest rates went way down. Okay, so house prices went way up. Okay, that's generally that would be like an inverse relationship. So when interest rates rise, bond prices fall. When interest rates fall, bond prices rise. This happens because new bonds are issued with current market rates. If older bonds have lower yields than new bonds, their price drops to remain competitive. Types of bonds. Okay, so we're getting to a little bit more of the important stuff. So government bonds, treasuries, right? Issued by governments considered low risk, okay? US treasuries, Euro bonds from Europe. Corporate bonds, issued by companies, higher risk but also higher yield. Municipal bonds, issued by local governments, often tax exempt. High yield junk bonds, okay? And so in a junk bond is more risky, so it has a higher yield. So riskier companies issue these, offering higher interest rates to attract investors. I mean, theoretically, anybody can issue a bond if you have a company, right? Hey, I just started this this nail company, right? And you want to buy our bond, but we're going to give you 20%, right? Something like that. So bond yields and returns. Investors care about the yield, which is the return on investment. Key yield types. More important stuff here. Coupon yield. Fixed interest paid annually. Okay? It's paid every year. Current yield. Coupon payment divided by current bond price. Yield to maturity, YTM. The total return if held to maturity, factoring in price changes. So like when you're buying a bond, the thing you look at is like, what's the yield to maturity? Find out how much money you're going to make before you get your principal back. Key players in the bond market: governments issue bonds to finance budgets, and this is where like the whole quantitative easing comes into play, is through bonds, right? Corporations issue bonds to fund growth. Investors, hedge funds. Investors, hedge funds, pension funds, banks, individuals, central banks buy sell bonds to control monetary supply and interest rates. Okay, bond market impact on economy. So bond yields affect borrowing costs for businesses and consumers. Rising yields can slow down the economy. Falling yields can stimulate growth. Okay, let me say that again. So rising yields can slow down the economy. Okay, so a lot of times they'll look at rising yields and they'll say, oh, interest rates might be going up. Falling yields can stimulate growth. The bond market influences stock markets. When bond yields rise, often stocks decline as borrowing becomes expensive. I'll say that again. The bond market influences stock markets. When bond yields rise, stocks often decline as borrowing becomes expensive. Okay, bonds are kind of a safe haven. So if you can get better return in the safe haven, because if a government is issuing you a bond, you know they're going to fucking pay you, right? What happens if the government stops paying? And you'd be more likely to put your money there as opposed to a riskier asset like stocks or crypto. And you can see that bond yields have continued to go down and just recently have gone back up. But I don't think this is going to impact the cryptocurrency market much. So what does the bond market tell us about crypto and future crypto prices? Interest rates and liquidity. So the bond market heavily influences interest rates, particularly through U.S. Treasury yields. When bond yields rise, borrowing costs increase, reducing liquidity in the financial system. This typically lends to lower investment in riskier assets like cryptocurrencies. Conversely, when yields fall, especially if the Federal Reserve cuts rates, that's good for crypto. Liquidity increases, often fueling speculative investments, including crypto. Number 2. Risk appetite and market sentiment. Okay, a lot of people base their decisions on the bond movements, right? On the bond yields, rather. That's more important than prices. As I said, they're inversely related. Excuse me. The bond market is often seen as a safe haven, whereas crypto is considered a high risk asset. I said this in a video ago, or a little while ago. I don't really consider crypto a risk asset anymore because of the volatility. It's always going to have that stigma. But you've heard big money come out, big institutional investors, hedge fund, BlackRock, saying, listen, crypto's here to stay. It's not going anywhere. The volatility is something you just have to stomach, okay? If investors are piling into bonds, especially U.S. Treasuries, it often signals risk aversion, which can negatively impact crypto prices. If the bond prices drop and yields rise, it may indicate expectations of higher inflation or tighter monetary policy, both of which can be bearish for crypto. Okay, so bond prices drop and yields rise, so the cost to buy a bond is cheaper, right? But you're going to get paid more for doing that. Okay, so in that case, you would just buy a more expensive bond, or try to anyway. It may indicate expectations of higher inflation or tighter monetary policy, both of which can be bearish for crypto. Okay, I just wanted to say that twice. Inflation expectations. Crypto, especially Bitcoin, is often viewed as a hedge against inflation. It is and it isn't. The bond market signals rising inflation. Okay, through higher yields on inflation-protected bonds like TIPS, crypto may benefit as investors seek alternatives to fiat. Okay, the dollar's a little strong right now. Hopefully, we see the dollar get a little weaker, and that's going to be good for cryptocurrency. However, if inflation leads to aggressive interest rate hikes, it could reduce crypto liquidity and suppress prices. Number 4, yield curve and economic forecasting. So an inverted yield curve, right, that's when the curve goes down, where short-term yields are higher than long-term yields, signals a potential recession. In economic downturns, investors might sell crypto for cash or safer assets. Okay, obviously, and you're going to see that happen in probably around a year or so. On the flip side, if bond yields indicate economic recovery with low rates, speculative assets, including crypto, often rally. Institutional investment trends. Okay, this is good to pay attention to. Many institutional investors allocate funds based on macroeconomic trends derived from the bond market. If bond yields are low and traditional investments often offer poor returns, institutions may shift capital into higher risk assets like Bitcoin, Ethereum, or altcoins. Okay, crypto market reacts to bond market events, and a lot of time we're not at the front. We're not able to front run this and look at the bond market and make decisions. A lot of times we're on the back end, but that's what this channel is trying to do, is trying to bring retail up to speed so we can make moves along with the institutions. Okay. Crypto market reacts to bond market events. So FOMC meeting. When the Fed signals rate hikes, crypto often reacts negatively due to liquidity tightening. Debt market stress. If bond markets show instability, rising credit spreads, or sovereign debt fears, crypto may act as an alternative asset. Quantitative easing (QE), which they introduced around 2008 after the housing market crash. When central banks inject liquidity into the economy via bond purchases, that is how they do it. Okay, that's typically all they do. Crypto typically benefits as more money chases riskier assets. Like the 2020-2021 bull rally was funded by quantitative easing, essentially. Final takeaway. The bond market acts as an indirect indicator of where crypto prices may go, especially in response to macroeconomic trends. If you're trading or investing in crypto, keep an eye on treasury yields, inflation expectations, and Federal Reserve policies to help you anticipate market shifts, okay? If you're big into crypto, watching the FOMC meeting is good. That's the thing that I kind of realized, and I said this last video, is to really get wealthy and really participate in the economy, you have to be aware of where inflation at, where the interest rate is at. I mean, you don't have to freaking study this shit night and day, but you want to watch, maybe not watch the FOMC meeting, but watch a YouTuber do an update on it, right? Keep an eye on crypto prices. Set up alerts on your phone, right? There's many ways to kind of get around the market. Maybe even if you're just an investor and you DCA into Bitcoin, yeah, sure, long-term holding is great. I've said many times, I'll say it again, I've got a bag of crypto of Bitcoin I'll never sell, right? And I continue to pile into that in case I am wrong, right? That's my hedge against me being wrong. But then again, I have a bag, and you might want to do this too, even if you have a long-term bag that you do sell, right? Try to time. You're not going to time the top of the market, but sell a little bit on the way up. You know what I mean? There's nothing wrong with that. Try to take advantage of what you know about the economy, and by learning more, you're going to give yourself more and better opportunities, right? So here's the last slide I have. What are bond yields expected to do this year, right? This is the most important part. So they're not going to do a whole lot, which is probably good for crypto because we're already in a bull run. There's already a lot of momentum. There's a lot of tailwinds. A lot of U.S. states are applying for crypto reserves, Bitcoin reserves, along with the federal government. So we don't want the bond market to really shake things up. Inflation is where it's at. Hopefully it will be steadily going down to around 2%. But again, I don't think anything's really going to disrupt the bull run that we have because we just have so many tailwinds. In 2025, bond yields are expected to remain within a specific range, influenced by various economic factors and policy decisions. Analysts project that the 10-year U.S. Treasury yield will fluctuate between 4 and 5% throughout the year. For instance, Morgan Stanley anticipates a range of 4 to 4.75% for the 10-year Treasury yield, with significant rate cuts deemed unlikely. Okay, it would be nice to see rate cuts, but that's probably not going to happen. We might go down another quarter percentage point, half percentage point, something like that. Similarly, Morningstar suggests that the 10-year Treasury yield will be contained within the 3.25 to 5% range in 2025. So, one thing I will say is, like, you see, like BlackRock, they're the one at the top of my mind. Like when crypto was building up and gaining more momentum and more adoption, BlackRock said all pretty much up until this bull run or within the last year, they're like, oh yeah, now we fully support crypto and we were wrong about it. They were buying the whole time. They were trying to keep prices suppressed so they could buy more. So sometimes you have to be wary and skeptical of what a lot of these big institutions are saying. Moving on, so several factors contribute to this outlook. The Federal Reserve has initiated a series of rate cuts, beginning with a 50 basis point reduction in September 2024, followed by a 25 basis point cut in November 2024. These actions aim to address declining inflation and support economic growth. However, the potential for expansive fiscal policies under President Donald Trump's administration, including increased government spending and tax cuts, may exert upward pressure on inflation and consequently bond yields. Additionally, the possibility of new tariffs, okay, this is not great for crypto, and trade policies could introduce further uncertainty into the bond market, potentially leading to increased volatility in yields. Despite these factors, the consensus among analysis is that bond yields will remain range-bound, with the 10-year Treasury yield not expected to exceed 5% in 2025. Investors should monitor economic indicators, Federal Reserve policy decisions, and fiscal policy developments closely, as these will significantly influence bond yield movements throughout the year. So there you have it. I'm trying to make the videos more fact-based, very deliberate. If you know a way for me to make them more entertaining, you want me to do more jokes in between, I can do that. But I'm trying to not go off on a tandem when I read something that I think is interesting. I comment as I can, but I try to fill in everything so I don't have to make a lot of comments, right? The facts are there. You want the facts. That's why you watch these videos. And the reason this channel is here is really help retail investors gain an edge, okay? Another thing I'll say is, like, this is completely off topic, but if you have a Coinbase account, when you see a new coin get listed on Coinbase, buy that coin, okay? I've hit 2 in the last 3 days, okay? So Story, ticker symbol IP, got listed on Coinbase. I threw some money into it. It went up 150%, okay? I've already sold out. I held on to a little bit. That's the thing. I never sell all at once, okay? I sell as it goes up, or if it starts to go down, or as the bull, because it doesn't stay out forever. It will go up within the first day, 1, 2, 3, 4 days, and then it will come down and find support, and then hopefully continue on an uptrend. One I just bought this morning, yesterday afternoon or last night. Damn, I keep burping. I saw a notification come through. It said new coin listed. KAITO is the ticker symbol, right? I bought some last night. I woke up this morning. It's up 60%. Okay, I'm going to continue to watch it. I'm looking for 100%, right? trying to double my money, and that's huge. But it happens within a couple days. So, like this is, I just made a short video on it that I posted, and I have another video of how to find early Coinbase listings. But these are kind of videos I want to make for you guys. I've been in crypto for a while. Okay, I live off it. So I want to try to share what I do, what I learn, because it's not that hard, right? You can have a full-time job, and you can still, double your salary with crypto, especially right now, because we're on a bull trend. It's easier to trade up than it is trading down. But that's the video I have for you. If you like the video and you like the content, hit the subscribe button. If you have suggestions or you want me to make a video about something specific, leave it in the comments, okay? Thanks for watching. Hopefully, I'll see you next time.